Hi, Didi.
So, just we are starting. So, good afternoon, all the participants for this our WOW series of October. And today is also our young women and young empowerment committee meeting is also there at WRC BKC. So, and I want to at the outset I want to thanks Drushti madam to accept our invitation to guide us on this new topic valuation of CA firm. But before this, I want to request you all to keep your right hand on your heart for our institute motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you all. So I recognize the presence of our dynamic and energetic innovative chairman C. Arpit Kavra, and I want to request him to say a few words.
Hello, everyone. Good afternoon and welcome to yet another episode of the WOW. WOW was conceptualized along with Drushti madam, and today she is also the faculty here at WOW. Thank you, Drushti madam, for accepting this invitation and talking to us on valuations. At WRC, we're just winding up with our committee meetings, the second installment of our committee meetings, and a lot of conversations, a lot of initiatives, and a lot of programs so far. I think let me share with all of you that in the last 6 months period, we have generated over 63,000 CPRs. That's been the highest that WRC has ever done. And I must really congratulate all my council members for this amazing feat. Also, importantly, these are some of the initiatives, these are some of the programs that we are doing at WIRC. And under these initiatives, most of our programs are structured. I want to invite, first of all, since Drushti madam is here, I want to talk about the newest project that we've launched, that is Project Prerna. Prerna is practice redesigning, empowering to become resourceful, to nurture by adopting best practices. Now, this is a project that we launched for all our women chartered accountants, especially who have, for different priorities in their life, gone out of the practice or gone out of the fraternity, and they want to come back in. And they could be the wisdom keepers of the firm. They could be the practice catalyst. They could act as a consultant to the practice and grow that practice in a very effective manner. Given the importance of documentations, given the importance of the audits and the quality and the assurance attestation engagements that we're doing, I think we all need a very strong guide in our firms who can really help and guide us in terms of how effectively engagement letters have to be made, how effectively we could implement our SAAs, the audit documentation, certification, attestation, everything. And in that series, what we're trying to do is we've launched a program called as Certificate Course on Executive Presence and Personal Branding. How can you establish your own executive presence and how do you do your personal branding? And that is what we have set up. There's a certificate course that we launched, and post that a series of 6 lectures on various aspects of what to do with the CA firm, how to ensure that the CA firm grows, does well, and help a proprietor, help a partner, and be a very integral part of that firm as it grows. So I think that is what is Project Prerna all about. Today also marks a very important day. We have launched the WIRC chatbot, Setu. So it's a bridge. Setu means bridge. It's a bridge between members and between WIRC. This chatbot is available on our newly launched website. If you go to wrc-ici.org, you will see a floating WhatsApp icon, which is written WRC Setu. You can click on it, and you can get all these services at just click of a button. And the bot is very intuitive. It's AI powered bot, and I'm sure with more and more machine learning, with more and more experiences, it will grow out to be a wonderful. As we increase the FAQs, it will come out very effective. If you were to avail any of our help in terms of health packages, be it Walk Hard, be it with Kokila Ben, be it with Lilavati, be it with blood tests and all of this, all you need to do is go on this, click on this bot, select the category, place yourself, and one of the best experiences, I'm sure you'll be pleased with the experiences that you'll have with this bot. The interaction that you'll have with this bot will be really welcoming. With all of this, we all are subscribing and we all are committed to the pride. We are celebrating this pride throughout the year. Perform, relearn, innovate, distinguish, and enrich. These words, I really thank you and welcome you to this once again WOW series of WRSK of ICI. Over to you, Pinky Madam.
Thank you, Chairman Sir, for your word of wisdom. And we start the new initiatives in this year for our for women chartered accountant as Prerna, and that program is going very good, and we will come out with the second series also. I think we had planned for second series of Prerna, and very soon it will be come out, and we will publish that. And
I must congratulate the Women and Young Member Empowerment Committee headed by CA Pinky Kedia and Shweta Madam for putting this beautiful program together of certificate course on personal branding and executive presence. Very good feedback, and I would request all of you, second batch is being launched. Please, whoever is interested, join us in that program.
Thank you. Okay. Thank you, Arpi sir, for always motivating us to do the good work and innovative works for our CA fraternity. And for today's topic is also very innovative, because we see are doing valuation of others' business, other organization, other projects, but never valued our CA firm. So this is also the innovative topic, valuation of CA firm. So we will make evaluation of ourselves, our CA firm, what we have generated in during the last say 20 years or 15 years of practice, what the valuation of our CA firm, how we can value that in market. So because right now we had heard that many senior CAs after 55 or 60 want to sell their business, their practice to any other CA if they want to. So it's a very relevant topic for today's life, and it's a requirement for all the CA. We are also getting the many phone calls. मैडम हमारी CA फर्म में ऐसे ऐसे प्रैक्टिस है, तो क्या वैल्यू हो सकती है, कितना हमें मिल सकता है यदि हम अपनी प्रैक्टिस किसी दूसरे को सेल करें, या कोई दूसरा टेक ओवर करेगा तो या मर्ज करेगा तो. So that's why I discussed with Drushti madam, and she agreed to take make the presentation and guide our CA firm. She told me that I will take some time, because I also have to do very a lot of elaborate discussion in that. So thank you, Drushti ma'am, to accept the invite for this innovative topic, and I guess all will enjoy the learning. And I recognize the presence of my council colleague CA Shweta Jain here, who are always beside me. For any initiative I'm taking, she's beside me, and she's taking all the lead and all the guidance. So Shweta, over to you, and please introduce Drushti madam, today's faculty also.
Thank you. Thank you so much. It's really an absolute pleasure for me to introduce Drushti madam in front of all the participants. So she is 26 years of experience as a chartered accountant. And recently, in June 2023, she did a certificate course on circular economy and sustainability strategies from Cambridge University. Congratulations, madam. Still, you are continuing in terms of learning. Really, it's a great. And her area of practice includes corporate advisory, merger and acquisition, advisory and valuations, direct tax advisory, succession planning, and family arrangement. She has served as an independent director on the boards of several listed and unlisted public companies engaged in the manufacturing, IT, and insurance sector. She has a rich blend of experience in terms of valuation and corporate restructuring and has advised transaction of India's largest public listed companies within the telecommunication, financial services, manufacturing, and consumer product industries. She has provided valuation advisory services for intangible assets, open offers, shares held under FEMA, and for transfer pricing studies. She is partner in Bansi S. Mehta and Company. Also, she served as a vice chairperson of WIRC of ICI in the year of 2021 and 22. A lot of programs I also worked with, madam. Thank you so much for all the good initiative, which is WOW is one of them. As a member of the subgroup formed under the Valuation Standards Board, she actively contributed to the drafting of the standards. Also, she oversaw the collation of the WIRC reference manual in 2021 and has contributed many articles and lectured on her area of focus. For WRC reference manual, I can say not only 2021, even last year also, I got a very great support of madam. Thank you so much with this brief introduction. Thank you so much for accepting the invitation and welcome to the platform of WRC, and over to you.
So thank you so much, and it's such a pleasure to be with all of you. Yeah. It's pretty nostalgic, to be here on this platform with everyone. So first of all, I must congratulate Chairman for the wonderful initiatives that he has been launching, and it's brilliant. The branding for every initiative. I'm really very impressed with every initiative's brand that you have created. That's very, very nice. And Pinky Madam and Shweta Madam, the effort that you're putting in that Prerna initiative, that's also a wonderful thing. In fact, if you have a platform where somebody can just enroll so that, we can take benefit of people who are getting certified, who want to come back into practice, maybe work from home or something, we would really be firms like ours would be really interested in participating. So if there's anything, just let us know, and we can even circulate, amongst friends and all, because there are many takers for this talent. So it's really, first of all, I must congratulate for the effort that you're putting in for the betterment of the profession and the lives of chartered accountants. Thank you. So I think, can I start off with my session? So the first slide, my title slide that I have, should I share the screen? Yeah. Okay. Yeah. So the title slide that I have is, I have called it Value Yourself as a Chartered Accountant, and I speak a few, lines on this. First of all, I must say I'm very proud to be a chartered accountant, because what I have learned, what we learn in the course of our curriculum, is really very, very good technical, knowledge that we learn while we are studying for CA. At the same time, we get practical experience. So there are very few courses which can compete with our course. The moment somebody becomes a chartered accountant, that person becomes employable immediately. And so while you are studying, you are also getting practical experience by way of articleship. So you take your articleship seriously, and you learn during your articleship, and then you become a chartered accountant of great value to business. So first, please value yourself. Don't think that we are worthless. We are much better. We are technically very, very sound. So we must understand our worth, and what is our worth to the business, or something that we must understand, and that has to translate into our fees. Because effectively, when we say value of a CA firm, it has to be in terms of some numbers, revenue, that you have to translate your value into use for your clients. So with this note, I can start my presentation. I made a very small presentation, but I will speak. Is the slide moving?
No.
No. I will just stop sharing. I'll share again. Sorry. Yeah. Okay. So when we have to value any business, or when a business wants to get value, you must understand that it has to first prepare itself for getting that value. And which will mean, as a chartered accountant, when we say that we have to prepare ourselves to get a value, we have to strategize as to what we want to do. What I have seen over a period of time is that we just do whatever comes our way. Most of us do whatever comes our way, and we don't really decide on in what area we want to specialize and grow our practice. So you may have the that general practice, but at the same time it is important to develop some sort of specialization. So while you keep on earning your bread and butter, revenue from the general practice, you can also develop some specialization, start selling your specialization to people who need it, right? So you have to first strategize, and you set a goal that what you want to do. So without a goal, you cannot reach anywhere. So it's very important that you set a goal also. Now, when you strategize, you will means, for example, I'll just give you an example. So nowadays, we know that there is a lot of focus on ESG, because there is a lot of scope in ESG, and although there are these assurance courses which have come up, there is a lot of work which is already flowing to the larger firms, and it is important that we also make some inroad into this right now. Otherwise, later on, we won't be able to build our credentials. We won't have the credentials, and if you don't have the credentials, you can't get more work, right? So it is important that at this point itself, you strategize that, okay, I want to start, in the ESG practice also, by the side by side along with my other work, because there is a lot of scope, and this is what I can contribute in this ESG work. Then for that, you will need to also develop your technical skill, and for that, maybe you will have to do some certification course. You'll have to read a lot of material, do some courses with other institutes and colleges, and you can learn something more, what is the best practice which is going on across the globe. So that way you can strengthen your technical skill. Once you strengthen the technical skill, then you can start selling that area of practice. So you can reach out, means when you meet your clients, you can always say that if you want anything to be done in this, we are there. And then maybe if there's anything, then the client will reach out to you once he knows that you have also done this certification course and you have this special skill which is the need of the hour. Now, one is that you talk to your clients. Basically, when you're just meeting them, they are asking, it happens that we meet over a cup of coffee, and then they say, okay, so what's new? What are you doing now? So that's the time when you exchange all these, all this kind of updates and information. But the other way is that you can maybe even connect with other professionals, because there are many people who have a good client base, they get inquiries, but they don't have the technical skill, and they don't have the people to deliver that service. So it is also very important that you meet with other CAs, because there are many other firms also who would be requiring these kinds of services if they have not developed the services themselves. So that is another way in which you can start getting practically exposed to the new area of work. The other way in which you can also, go about developing your practice is also to collaborate or basically, connect with other professionals. And one example I can think of is immediately legal professionals. So they have a lot of clients, and they keep having, a lot of questions about maybe tax, some structure. So if you have some lawyer friends, and they know that you are into a particular thing and that is something that their clients would require, then they will reach out to you, and that is also how you can develop your practice. So this is how you will be able to build on a new area or strengthen the existing practice areas. Hmm. So you have to prepare. You cannot just straight away go and say that, okay, I want to sell my practice, give me some price for that. That doesn't really work, because you need to go with a strong infrastructure and credentials when you want to sell your practice. Or basically, if you want to buy the practice, then this is what you see in the practice that one wants to buy over. So this is something that I always tell everyone, be it in the firm or outside. Always say that, why do you need to collaborate? Because every professional has limited time on hand. You have 24 hours only. God has given us only 24 hours. Out of 24 hours, you can work for say 12 hours. But how much more can you work effectively? So there is a limit on the amount of time you have on hand. And so there is this limit which is absolutely, which is a finite limit on the amount of work that you can do. Because when you take some job on hand, one has to also deliver on that. So you need to, that is why one cannot do everything himself, but it is something possible only if you come together. So I may like another area, but I may develop it, but I know that I cannot really take that area on my platter right now, because I know that I'm already busy with certain things which I'm doing. So maybe once I develop that area, I will build a team, because a team will have to do that area, and that's because I will be able to build my practice on their time. So time is something which is the most precious commodity for us. Second is the quality. We are service providers. In service, it is the quality that matters. So if you are not able to, give justice to the work which is on hand, then somewhere the quality of that service suffers and the client will be lost. So it is important that we restrict ourselves to the work where we how much work we can deliver with good quality, which is again flowing from the availability of time. And the third most important thing is that size is very important. If you don't have size in operations, then the practice cannot grow. You cannot even employ more people. See, once you have just yeah, once you have a reasonable size of operations, you will have enough kitty that you can do certain perks. You can give certain perks to your employees, improve maybe their working conditions, get more infrastructure, IT infrastructure, and make work easier, better. And so you will be able to attract more talent. So for reasonable size of operations also, you need to have more people working together, because only then you can have more practice. So those were the precursors for collaboration. Now we come to the value drivers. This is the most important slide. So what are value drivers of a typical um, CA practice, or for that matter, any consultant's practice? What are the value drivers? So one is a technical strength of partners. So if you have a practice where there are partners with different technical strength, they are very strong in their technical strength in different areas, that becomes a big positive for valuing the firm. Now, second is persistency in client relationship. This is a very very important factor, because when you find in a practice that clients have continued over a long time, say 10 years, 15 years, it means they are very satisfied with the job which is done. Okay, they are also willing to pay fee and they have continued for a long time. That is a perfect client relationship. They value you as a professional, they value the services which are given, and it is itself a barometer that the work is being done to the satisfaction of the clients, which means that the infrastructure is right, the partner skill set is right, the team strength is right. So persistence in client relationship is very important. I will tell you how this goes into valuation of a CA practice. We'll talk about that. Then comes the age of the firm. So older the firm, automatically the firm will have more client relationship. It has a wisdom which has transcended over a period of time. So that is also a very important factor, age of the firm. So older the firm, it will be also looked at very positively. And there was also a study which can you hear me?
Yes, yes.
Okay. Yeah. So those organizations which work in a particular way, ethical way, will be the ones which will last for over 30 years. So age of the firm also is an indicator of the way of working of the firm. It also shows the ability of the firm to assess the risk and take the right steps, because if you take very risky steps just to grow fast, then maybe you will face a lot of problems. And we know it's really very very large firms which have collapsed in the past because of the risky positions and the risky certifications which were done by them. So age of the firm is a very important factor. Next is partner composition. So when I say partner composition, I mean the age of the partners. A firm has to have a mix of old and young partners. So when you have older partners, they come with wisdom of time. They know things. Uh, they will be very wise. They will not take any risky positions, and they will not take they will know what to consider seriously. And the younger partners bring strength to the firm. So when it comes to a good mix of old and young, then the firm can move very in a very strong manner. So you need to have a good composition of partners. Then we have the service vertical. So when you look at a firm and there are some new service verticals which are developed by the firm, which are sunrise sectors, then that firm will always have a better valuation, right? And then of course the credentials and empanelments and all. Now when you look at service verticals, I don't want to touch upon that again. If you see certain service verticals where you know that maybe these areas will very soon be overtaken by automation, digitization and things like that, then you know that these are sunset areas, and maybe very soon all these things will be done away with. So again, in such a case, that kind of a firm may have a lower valuation. Then you have to look at the credentials and empanelment which are there with the firm. Yeah. So now let's look at this. Why would a yeah. Okay. So what are the scenarios? So what are the scenarios for valuation? So what are the scenarios when somebody has to value a CA firm? One is, as Pinky Madam said at the start, there are many firms where there are older partners who want to exit from their practice, and they want to sell their practice to someone. So that is the first case, which is retirement of partners, and that is where one pays compensation for taking over the client relationship. But here, if the partner doesn't continue, then in that case there will be, you'll have to rebuild the strength. So here you will have to actually invest a lot of money into kind of having seniors to take over those relationships. You'll have to build, if you are not getting the staff from that firm, then you'll have to build a team to service the client relationships. Of course there can be also some cross selling possibilities which you can get from those kinds of firms and the relationships. So those things can actually be a good lever for valuation of the firm. Next is, the other three are collaborative mergers, and actually, in my mind, the best way to grow your practice is through collaborative mergers. Retirement or buying over practice is a very, very difficult thing, because what happens, in case of a retirement or buying over practice of a person who wants to exit his profession, his professional service business. So in these cases, since the person would be old, it is possible that he may not have enough people in his organization. The clients might continue with him till the time he's there, but they also know that he's growing old and he doesn't have a second line, or he doesn't have many people to look after the practice after him. And so the clients are also generally smart enough that they start looking for younger professionals to support them on the areas where this old gentleman cannot serve. So already they have some sort of a backup available. So the moment the person, the older professional retires or sells the practice, there is a good chance that the client might say that, okay, I already have someone on board and he knows my business very well, and so I would rather go with a person, with that person. So even though you may be buying over somebody's practice, it is possible that you may not really be able to get any revenue out of that practice if there's already a relationship which is built with another chartered accountant who's younger in age. So buying over practice has its own pitfalls, and one has to be very, very careful with that. So in a case like that, one has to also see that you can have the payment over, say, 2 years or 3 years. Now, payment over 2 years or 3 years will all depend on what is the compensation you are willing to give the retiring partner, which I cannot say that it will be X or Y or 2X or 3 or X or 5X. I can't say that, because every firm has its own strength. And as I told, there will always be a possibility to cross sell. The relationship means your services to the relationship. So if you are able to, so for example, if the person who was in practice and who's selling his practice was only into, say, a particular practice, say he is into income tax practice, and there is one more area which you have and which can be sold to the same client, which service can be provided to the client who's coming along with that practice, then obviously you will factor the benefit of that revenue, and you will be able to give some higher multiple, which is nothing but a synergy benefit you are giving the retiring partner. But it will all depend on a case to case basis. And before I talk about anything further, I must tell you, when you value a CA practice, it is not that CA practice is anything different from any other business. CA practice also has revenue, it has cost. We know what kind of percentage of cost we have to incur, what kind of infrastructure cost we have to incur. We know the kind of margins that a CA firm will typically earn. and based on that you can very well, compute what will be the price that you are willing to pay, and this will be based on nothing but the cash flow that you will build. Now, how do you build the cash flow? That for that I will go back to the earlier slide where I have said persistency in client relationship is very important. So when you see persistent client relationship, you will be able to build cash flow for a longer period from that client. And I'm not saying that you build that cash flow for 10 years and 20 years. That person might have had that client for 15 years, but doesn't mean that he will say, okay, now you pay me for 15 years cash flow that you will generate from that client. Because once the person is gone, it is only because of your own service ability then the client continues with you. So at the most you can continue to see that, give some credit to the selling or retiring partner, in my view, for say next 5 years, because after 5 years if you have not rendered services up to the mark of the satisfaction of the client, then the client will be lost anyways. So you can maybe give credit for 5 years for the client relationship which is continuing, which you are able to get, but that is only if the client is a very long relationship where you know that definitely based on that, and if I serve the client up to his satisfaction at least for next 5 years, he will definitely continue. And after that, of course, it is just because of your own strength that the client continues, and the client will go. So a CA practice valuation is also to be done based on what is your expectation of cash flows from the service which is being bought over. Now, next we look at a collaborative merger with a pass-through. Now, this is a very interesting kind of a merger, which is, in fact, it's a win-win for both the collaborating partners. And in this case, nobody's buying over anybody's practice. People come together, which is expansion. It's a real expansion where somebody has one set of vertical and the other one has some other verticals, and these two come together so that uh, all the clients will get everything under one roof. So this is an expansion. This is a collaborative merger with a pass through. Now when we say there's a pass through, what is the meaning of pass through? Pass through means that whatever each one was anyway earning from his client, that is anyway going to belong to that pool of partners. And then when there is some additional work which is generated because of cross selling each other's services to each other, then there will have to be some mechanism which will be set so that you give credit to the pool which is generating the revenue and giving it to the other pool. That is a very good way of going ahead, and which is a win-win for all the persons coming together, because there is only a positive, there is no negative here, because there is a pass through, so everybody continues to earn what they anyway were earlier earning, plus there is there is an addition which is cross selling of each other's services. And even whatever is a cross selling, for that also there can be certain arrangements, so that whoever is referring can also get benefit of the referral which is done between the pools. So this is an excellent way to grow the practice. The third thing is, this is that what I talked about is expanding service verticals, where there are two firms with different verticals and they come together. Okay. Now there can be also instances where you want to do a geographical expansion. Again, that also will be a collaborative merger with a pass through, which is the model should be similar to what I discussed for expansion of service verticals. It's just that here you have different geographies. You come to means practicing professionals in different geographies come together, so that if somebody says, okay, do you have your office in this particular area, I want to get this work done here, you will not be able to say, okay, no, I don't have. You'll say, yeah, I have, and automatically the referral will go to that branch, and then the branch will deliver. Of course, in geographical expansion also, one has to invest in terms of infrastructure, because it may happen that between the different practicing firms, the level of infrastructure could be different. um, the IT support, the systems, infrastructure could be different. And the perks, the benefits could be different. And so, in geographical expansion, if there's a smaller firm in a different geography that comes together with a bigger firm, then the benefit of the larger firm setup and the infrastructure will also flow to the smaller firm, and then it will be able to even retain more people, and will be able to serve more people, and will get good referral also. So that will be a very, very good situation for both the collaborating firms. And then, of course, the other one is where you are just looking at revenue growth, where both the firms are rendering the same set of services, but then you want to come together so that you can have a larger revenue, which will obviously give you more bandwidth to provide more benefits to your employees, to attract more talent to the firm. So that is also a good way to grow. So that is also a collaborative merger where people come together, because if people don't come along, then it is very difficult to build the entire infrastructure, the strength, people, team, client relationship. So it is better that you have a collaborative merger, because that comes with client relationships. Okay, now I come to this, which I talked about a little from here, but I will talk in depth about this buyout of existing partners, because I know that Pinky Madam was very keen to understand, how do you value in case of a buyout of existing partners. So
Yes.
in this case, what one has to see is what is the age of the firm, as I told you. Age of the firm will bring along with the strength of the brand. Uh,
Your voice is cracking, Drushti.
can you hear me?
Yeah, no, it's cracking.
Okay, just a minute. Just give me a second.
I think if you can switch off your video, then it might be can.
Okay, no, I changed my network, so now it's better.
No.
Can you hear me?
You can see, yeah, I can hear you, but your
Can
PPT is
you
not
hear
visible
me?
now. You switch off your video. You switch off your video, Drushti ma'am.
No, I will just. Okay.
Yeah, now it's okay.
Yeah. Okay. Okay.
Yes.
So what is very important is the age of the firm, as I told you, but and the brand. But when people don't come along with the firm, so if you don't have the senior partners coming along or hand holding for some time, then it's a very big pitfall, and you may not get the benefit of the age of the firm and the wisdom of the senior partner and the relationship that he has built over a period of time. So it is an important thing to have, an older firm, but again, you have to be very careful about this pitfall. Second is the service vertical. So what are the service verticals? So is it sunrise sectors, or is it sunset sectors? So that's what you have to assess. Now, supposing, like for example, it's an old firm, but it has developed a very good practice line, say IBC. Okay, where there is a lot of work, there's a lot of opportunity and practice in this. So that would be a very big plus if another firm is not really into this area of practice. So service verticals are also very important because that firm would have developed the credentials, it has developed a team, uh, and so it would be a good thing. But if the none of the existing partners continue, then to serve that service vertical will be a challenge, a new service vertical, because you don't have it yourself. You don't have the expertise. So how will you solve that call? It's you're just buying over a form. Now, continuity of client relationship, that is what I highlighted earlier. That is, if there is client relationship which has continued over a long period of time, you can, give some weightage for that, and you can assume that that client relationship will continue with you for a few more years, definitely. And that is all, credit to the retiring partners, that they have built that strong client relationship, and you will be able to get that. And so you can give a longer period, credit for the cash flows to those client relationships. Then the other thing is the revenue growth. If you can see that in that firm where the partner is retiring, that the revenue of that firm has grown very well, or then it will have a very good impact on the multiple, because that he has the right infrastructure, he has the right set of people to grow the revenue. Of course, one has to see the composition of people, the team, and everything. If it is just a single person who is rendering service and getting higher revenue by, getting a few deals or something or whatever, then that may not have continuity, and so you may not give a long term cash flow for that kind of revenue. In fact, you may not be able to give any value for the revenue he's generated in the past if there is no team to carry it forward. Okay, so that is one thing.
Drushti ma'am, we can't hear you. Drushti ma'am, Drushti madam.
Can we call her?
Oh, yeah. I will call.
Yeah, sorry, I think I had a bad network, and because of that, I had dropped. Uh, just give me a second, I'll just start sharing again. Yeah, okay. Okay, so revenue, when you see that there's already, shrinking revenue of the firm, it means that client relationships have already started souring, and the clients have started moving out, which means even the existing clients who are continuing because of some, old relationships with this older gentleman, it's possible that they might have already built relationships elsewhere. So in such a firm, one has to go in depth and understand, what is really the scene on the ground. You can have meetings with the clients and also understand from their body language whether it is possible to get them, whether they will onboard the acquirer or not. I think it's a very important thing there. And then, of course, the profit margin. Now, when I say profit margin, you will say, okay, it must be that higher profit margin, we have to pay a higher price. But I will say reverse. If the normal margin of a firm is, say, hypothetically, say 50%. Okay, so if the normal margin is, say, 50%, and if this person is earning, say, 60% margin, okay, then it would mean that there are certain costs which he is not incurring. Being an old timer, he is not invested probably in infrastructure, in IT infrastructure, which is costly. But without that, one cannot really deliver good quality service. So if the margins are very high, then one has to deep dive and understand if there is adequate, expense which is incurred for, updating the knowledge, updating the service. If it is not, then one has to build that also and bring the margin to a maintainable level of margin, and only after that you can build your cash flow for how many ever years depending on the client relationships which are there, and then you can uh, take our present value and come to what should the price should be paid to the selling partner. So these are some of the key drivers in case of a sellout. Now, the other thing which one has to look at is the period of payout. So it's very important in such cases when there's a buyout of practice. It is advisable, and what I have seen is that people don't pay everything upfront. There is certain percentage which is paid upfront, and there's certain percentage which is paid over a period of time. Now, why period of time? The reason for paying over a period of time itself is because you are not sure if those client relationships that you are buying over will continue or not. So if it is not going, if it doesn't continue, then you will have to make some adjustment that we made to that exiting partner. Now, there will have to be understanding, because the retiring partner may say that, see, my client relationships were very strong, they were very happy with my service, but it's only after you have come in that they are not happy. So it is your problem, and why should I not get a price for the relationships I am selling to you, right? So there can be a lot of back and forth which can happen, and that is where the bargaining strength of each side lies. Okay, and the trust on each other. Yeah, I had again dropped. Seem to be having very bad network. Okay, yeah. So okay, so in these types of MOUs, you will have a provision for adjustment to the payment based on certain milestones, and the milestones will be based on, the percentage of clients who will continue, and the profit margin that you have assumed at the time you bought over the practice. So you can build a delta. It is a mathematical thing, and I'm sure all of us chartered accountants are very, very good at numbers. We can very easily, put a, number to the assumptions that we have. So adjustment to payout can, based on milestone, can be easily computed based on what is your expected revenue and the profit, and how much percentage you can assume as, considered for continuity. And if something goes from there, then you can adjust the future payment, but this has to be all very, very well documented. Nothing should be just, understood. Everything has to be black and white on paper. Yeah, I think this is something that I covered, which is, continuing revenue, maintainable margin, which I discussed. Multiple to margin, which is, yeah, this is another thing. From multiple to margin. Now, how do you determine the multiple to margin? So Only that you will make a futuristic position. You'll be and then you will also compute what will be the additional you will to generate from these relationships by way of cross selling. You will be able to then build that revenue, which will be something that you will offer later. As a buyer, you will offer that first. You will put up a value to the existing relationships and the existing practice, because that is what you are buying over. And then, of course, if the seller is very strong and has very, very strong client relationships and very good. Can you hear me? Hello.
Yes, ma'am.
Can you hear me?
Yes, we can hear you.
Okay, okay, okay. Okay. So if there is a good strength, means with means good strength that he has with his clients, then in that case he will be able to sell, your additional services, and then he may even ask some higher multiple based on what his expectation of the additional services he will be able to sell for you. And that is basically the bargaining strength of the seller, and of course the buyer's bargaining strength, which will come in. Okay, milestone based payment is something that I talked about. Now we go to collaboration. So collaboration is basically for expansion. You get the partners, you get the team, you get entire infrastructure. So collaboration is the way to go for expansion if you are looking at expansion. What are the golden rules of collaboration? You want to give better spectrum of services, you want to expand your client base. That is one important facet that you want to achieve in collaboration. You will compensate the service requirements of the collaborator, because what happens is in many cases that two collaborating firms have and the
Ma'am, your voice is breaking,
has
ma'am.
requirement for the
Drushti,
other
ma'am,
service.
your voice is breaking.
Yeah, yeah. Okay.
Now it is clear. Now it is clear.
Mm. Okay. 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 Yeah. Okay. So in case of collaboration for service verticals, each collaborator will be able to sell to his client the other set of service providers services, and so each one is compensating, for the other person's lacuna in the service, and that also has certain positives for the person who's referring, because otherwise, his clients were anyway going away somewhere else. Now, instead of that, the clients are now staying with the firm, the firm which has come together, and the set of partners who earlier were not serving that set of clients, who are getting new relationships, all thanks to the collaboration. So then there will be some sort of a compensation or credit mechanism which will be built for the collaborating parties. Most important is that you need to have clear commercial understanding, so that there is no confusion, because a relationship cannot go ahead if there is any confusion, if there are expectations which are different from what is
Drushti, ma'am, again, there's a network issue. Drushti, ma'am, there is a network issue, ma'am.
Can you hear me now?
Yeah, it's clear now.
Oh, I'm so sorry. I don't know why I'm having so much network issue suddenly. Huh. So it is very important that the collaborators have a very clear commercial understanding, which should be reduced into writing. It should be in form of an MOU, which should be signed between the collaborators, and eventually obviously into a partnership deed, because if everybody is coming together in a single partnership, then there will have to be a partnership deed which will have to again echo what the collaborators have agreed in the MOU. So it's very important to have very, very clear commercial understanding. And the most important thing for a collaboration or a merger to continue is trustworthy behavior. If there is something where you want to, if one side tries to cut corners, say for example, if the referral comes from the other collaborator, and the person who's rendering the service doesn't acknowledge that and just says that, oh, this was an existing relationship, I got it through someone else and it is not through this, then in that case, on small matters, the whole collaboration will collapse. So it is very important to have trustworthy behavior. Means one has to have trust, and one has to behave also in a trustworthy manner for the collaboration to succeed. Now, as I discussed earlier, what are the key drivers for collaboration? You have to see the brand strength. Different collaborating parties will have different brand strengths. They might have geographical brand strength, or they might have area specific brand strength. So these brand strengths will have to be identified. Based on that, you can, come together. But because in case of a collaboration, if it is a pass through plus certain credits which are given for the the work which is referred to each other, there is never a downside, there's no pitfall. It's always an upside which is available in case of a collaborative partnership that has happened. Then one has to understand the resource contribution of the parties. Now, for example, as I said, in case of say one firm has got very good IT platform, and they are using that IT platform, whereas the other firm doesn't have it. The firm which is with whom they are collaborating has developed this IT platform, and then now they have a very strong platform which is made available to their clients also for certain services, and the other side doesn't have anything like that. Then maybe for this IT platform also there can be some credits which will have to be considered to be given to the collaborating firm, because this itself is a very big area, where there can be good practice development. Identify the efforts of the collaborators, in which case one has to give what kind of credits which will be available to the different collaborators, based on say if somebody is just selling the cross selling the services, uh, or if somebody, so there are different types of efforts. When one comes together, you know that this firm has these positives, I have these positives, and you come together and you know what you will be able to achieve together. So the efforts of different collaborators has to be also given credit for. Now, if there is one collaborator which has a stronger brand, the other collaborator which has a service vertical, then it is possible that the collaborator which has got stronger brand and good client relationship may even have some sort of a royalty or some sort of a credit for the brand, and the other collaborator has to agree to that, because it's a ready client base which is automatically provided. And also with that brand strength, you will be able to also charge a higher fee, so automatically there's a win-win for both. Then overall cost structure of the merged entity, that is, if the two collaborating parties have different cost structures, they have different infrastructures, IT infrastructure, then, and if when they come together, they'll have to have a standard level of service provision and cost structure. Maybe there will be a similar kind of cost structure, may not be exactly the same. Like, for example, if you are looking at different geographies, you may not have the exact same cost structure. But then if you're going with the pool system, of profit determination, then there is absolutely no pitfall for anybody. If you are able to save, if one collaborator is able to save on some cost, um, because of the geographical presence in a particular area where the resources are available at a much lower cost than the other place, then he will anyway be able to get the benefit of that profit. But mind you, in geographical areas where the resources are available at a cheaper cost, one has to also understand that in that geography, even the services will be paid lower. It will not be as much as what will be paid in the other geographies, So one has to understand these kinds of differences, and the pool profit can be determined. Now when, if you are looking at a there can be there can be other situations where you are looking at merging different geographies and different verticals. Now different geographies are providing different service verticals. In that case, if they are coming together, and if the vertical which is offered by the geography where the resources are available cheaper, that service is being used by another geography for the client, for serving the clients, and that geography is a very lucrative geography, then in that case there will be a very high margin. Can you give credit for the entire margin to the geography and the collaborator with lower cost? And I will say no. So one has to think through when you are collaborating and you are documenting all this, you have to think through all these situations, and you will have to put up, your different credits which will have to be given to each other. And of course, fixed compensation for the various drivers. Now, these various drivers are, as I said, marketing strength, the brand, IT infrastructure which is available. So, all these kinds of different drivers which are there. Maybe somebody has a very good network of clients and relationship. So, these different drivers will have to be compensated. Now, all these things will be discussed at the time when the two collaborators come together. They initially and pen it down in an MOU, and then after that it will get into the partnership document when it is signed. So I think that's it from my side. I would say best wishes for a successful expansion. And now I can just look at me. I will just stop sharing the screen. Uh, I will just look at what are the questions which are there. Okay. There are no questions.
If anyone,
I
if
can't
anyone
see
want
any
to ask any
questions.
question, yeah, if anyone want to ask any question, please put your in chat box or Q&A, so we can take that question answer.
How to value goodwill of a firm. So goodwill of a firm means you are basically looking at retirement of a partner, correct? That's exactly. Okay. Lots of questions. Good. Okay. So how to value goodwill of a firm? So when a partner is retiring, see what happens is that you have to it's a very very difficult situation because the entire relationship will have to be managed by you, and you have to manage it along with your existing client base. So you will have to recruit more people, you will have to build a bigger team, you will have to have probably one more partner to service the client relationships which are coming in. So if one were to look at all these costs, and then you were to take a present value of the cash flow, say next 5 years, I don't think beyond 5 years any relationship can continue because of the predecessor. So if one were to take a present value, and considering that this is a relationship which could be risky because he's old, if the partner is retiring at an age when the clients have already started looking for an alternative, then maybe there is high risk to continuity of that work. And so your discounting factor, like typically in a DCF we have something called the beta. So over here the discounting factor will have to capture, what is the probability of the clients continuing, and which there can be a risk factor. You will have to load some risk factor. So if I have just done, some rough working for these types of situations, even if one were to say that if instead of buying a CA practice, I were to park this money, say in say financial market, and if I were to earn a 15% return, okay, then at least that 15% discounting I should take. And if I were to take normal growth in the business, then there will be, say, a multiple which will emerge from that. I will just let you know I had done some working for that. It's not very high multiple as such, but that's because you have to build the entire team, and from the senior person to the junior person. So once you absorb all those charges, the cash flow that remain will be not much. So buying over goodwill of a practice, as a thumb rule, maybe in the market you can look at a 3 times multiple. Just a minute, there's another question here. What are general multiples of margins taken? So as I said, you cannot generalize the multiples of margin, because that person might have earned a very high revenue in the last year, but that is not a continuing revenue. It is a one-time revenue, high margin. So it is important that you look at the revenue. You will have to, in fact, in consulting practices, when there is a takeover of practice, um, there is a 4 to 5 years revenue analysis which is made, which is party wise, and what is the stream in which that revenue has come in, and the consistency in that is seen. After that, there is a probability attached to every stream, that okay, this from this client, this revenue has continuously grown over last 3 years, so there is a good chance that this will continue. I will take it for next 5 years. So okay, I will take for 5 years. But if I see something has just come in last year, it was never there earlier, or maybe it was there before 2 years, again something has come last year, I may attach not that high probability, because this is a client who is going all over the place and looking at different service providers, and he's not going to continue with me for long. That is how I look at it. So then you will have to actually build a whole cash flow and come to the the probability of what cash flow will come to you, and then you will apply some sort of a discounting depending on what you think is the minimum discounting for you. Now, as I said, if one were to look at it as a financial asset, because it's going to generate profit for you in future, you might compare it with other financial assets. But I said some in one slide, there's a good chance of cross selling other services on the basis of the client relationships which are taken over, then that can go to reduce your discounting. So instead of 15, you may take a 12%, or you may even take a lower one. It all depends on the strength, the bargaining strength of both the sides. So there is no one multiple. You have to sit down with the numbers. I can't tell you, because if I say that this is the multiple, then it is possible somebody will actually do a deal at that multiple, and that multiple will be completely wrong. It may not be relevant only. You have to see case to case. You can't have a single multiple for any consulting practice. In case a deed is silent on goodwill computation, no, when the person is selling his practice, then of course he will have to put down. No, when he's selling the relationships, he's selling the practice. That's what I'm saying. Then make it very clear. The person who's selling has to write what is the goodwill that he is going to get, and over what period of time. So that is on the buyer. Buyer will say, no, I'll pay you over 2 years. I will not pay you immediately. So he will pay over 2 years, and that will depend on what is the expectation of client relationships to continue. And if client relationships don't continue, then in the second phase you can adjust the shortfall in the revenue which was expected. But the deed cannot be, when you're buying over CA practice, deed cannot be silent on goodwill. If it is silent on goodwill, then the selling partner doesn't get anything. Why should somebody sell practice for nothing? Okay. Of course, if it is a case where there's a collaboration, it is possible. The deed can be silent on goodwill. But if there is a bigger brand and there's a smaller brand, then it is quite likely that the bigger brand could say that okay, this will be the royalty which has to be paid. Or if there are certain licenses and there are certain permissions which are additionally required, then the person in the jurisdiction which has got those licenses and permits will take a certain percentage as a charge for the existing licenses and permits for doing that work. So it depends on what is the exact situation. Um, then how do you value firm when it is acquired by some other firm? Are there any indicators based on recent deals? So when a firm is acquired, so when I means I would say it is, there is nothing like acquisition. Acquisition means you are just acquiring the relationships and the partners of that firm don't continue. In which case you can just simply do a cash flow based valuation. There are relationships which come along with it, and then both the buyer and the seller will sit across the table and come to a value, and the buyer will look at what are the uh, present value or discounting factors that he can take, what best he can take considering synergies that he expects to get. That's something that I talked about. uh, I can't say that there are any very very set multiples for buying over practice or buying consulting business. uh, it all depends on the strength of each business. Is there any bar in CA regulations for paying goodwill to the retiring partners? No, there's no bar. Can I value a CA firm even if there is no exit of a partner at that point of time, no present value of cash flows, and does that valuation or sorry, there is no exit of a partner? Okay, so if you are buying over somebody's, this is a case where there's no exit of any partner from of the collaborating firm, and you are paying that firm based on present value of the cash flows, and in future again you are going to pay those partners will draw share of profit, so you are going to pay, you are going to duplicate the payment. So as a chartered accountant, please look at this very commercially. Understand you are not going to pay somebody twice, right? So if he's going to take also a share of profit, and if that person is also saying, "Give me present value of next 5 years cash flows," then of course you are going to say a no, because you are going to pay him his share of profit also. Maybe you can pay him something for in future when the referral comes, the cross selling happens. That time you can always pay him based on the cross selling of services. That is something that will happen. Asking this once, I was mentioned that without selling a stake, your valuation makes no relevance. No, it's not like that. When you come together, you have a bigger kitty, right? So of course, when there is a bigger kitty and then there is a bigger, pool, but both the pools will be determined separately. Can you hear me? Okay, okay. So the other question is that this gentleman was told that without selling a stake, your valuation makes no relevance. Yeah. So if the person is selling or he wants an upfront consideration and is not also giving up any part of his share in profit, then of course, then it doesn't make any sense. If you are taking an upfront consideration, then you are selling a part of your future earning capacity. So you will have to take a hit in your sharing ability. You'll have to give up some part of your share, of course. But if you are not taking any hit in your if you're not taking any consideration upfront, then you will continue to earn in future along with the rest on a much larger scale, because everybody will cross sell each other's services and it's a win-win for everyone. Is there any source to do benchmarking for multiples? You have to see on a case to case basis. I've been told many times that you give a multiple, but I am very reluctant to do that because every time you do a valuation, multiples will be different. It depends on each firm and each scenario. So one cannot have one standard multiple in any case. There is no benchmarking of multiples of this type. We have understood there are various factors which should be considered in valuing a firm, but if some small firm wants to sell its practice, is there any normal multiple which we use as net profit or gross revenue for calculating the firm's value? If there's a small firm which is selling its business, of course, then one has to look at, there is no standard multiple. If your practice is a declining practice, your clients have gone away because you have not been able to provide certain services, you are not able to catch up with the latest way of working, then in that case, how will you get a standard multiple? There's nothing like a standard multiple. Every case has to be examined separately, and the multiple will be fixed based on what is the probability of revenue continuing. Is there anything else? Yeah. Should we insist on taking proper legal firm to draft? Of course, yes. Such agreements. Generally, small and mid-sized firms tend to Yeah. Drafting is absolutely important. You cannot ignore drafting. So you must take help. So you have to first lay down what is really in your mind, what you both have agreed to, and then it should be, you can take help of a law firm after you have put in everything, all the clauses. Then you can take help of a law firm to just vet your document and give suggestions. So it's a good thing to have a proper document. DCF should be done at partner level or firm level, as sometimes it is difficult to segregate between firm clients and partner acquired clients. Yeah, the DCF should be done at firm level. See what happens when you are in a firm. Uh, and if the firm has a good brand, then acquisition of clients is also in a way partly also dependent on the strength of the brand. So it is not purely the partner who is really getting the clients, it's also the firm which is known, which has worked over a period of time, which is able to get the clients. And it also happens that in a firm somebody has seen, like for example, a group of companies has say used the firm for a particular service, and they are satisfied with that service, and so when they get some other service requirement and they are looking to someone new, they might say that, okay, we were very happy with this firm for service A, let's look at the same firm for service B and see how they work. you know so it is not just the partner who's getting that work who is responsible, but of course the partner has to be proactive, because there are leads which come and the leads have to be well attended to. If that attention is not given to the leads, then also the clients will not, means it will not translate to revenue. So it is a firm level valuation which has to be done in case of a selling thing. Otherwise, if it is just a collaboration, then in that case, it will be a pool of profit which will be determined for each collaborator, and then they can share it in the way they want to within the pool. Yes, I think I have answered the questions.
Ma'am, you're not clear. Your voice is not audible, ma'am.
So I said I've answered all the questions which are there. There were 11 questions. I've answered them. I think that should be good. I hope I have made some sense and cleared some doubts through this session.
Is anyone like to ask some questions to ma'am, please? Ma'am, it's in chat box, ma'am. I'll read it for you.
Acha.
If a 60-year-old proprietor concern is
Yeah, I
sold
got it. Yeah.
with staff who alone are involved in servicing the client.
So,
Yeah.
yeah. Servicing the clients, and the proprietor intervenes in emergency situation only, and the net profit is around 70%. The gross billing can okay, so the gross billing, how many times the gross billing can the concern expect? So first of all, 70% of the gross billing is the profit, and the old proprietor is, so here there is a very good relationship with the clients. So it's only the employees who are entering the service, and the proprietor only steps in emergencies. Otherwise, the employees only are entering the service. So of course, then one has to look at the cash flows continuing, but one has to also understand that the new firm, that is the firm that is taking over the proprietary concerns professional practice, will have to first also showcase that this will be the partner who will serve you, so that in case of any problem, he is the one you're going to look at. There has to be that comfort which the clients of the proprietary concern should develop with the firm that is taking over, and it has a 70% margin. But whether that 70% margin is sustainable, because if it is a proprietary concern, it may have certain setup. It may be not possible to continue with that kind of setup under a different brand. There will be certain minimum cost which will have to be incurred. So maybe that is looking a bit too steep, and it may not continue. But it depends on the strength of the seller, selling professional, as to how much he will be able to push that 70% margin. And that 70% margin, and if one can see that this work has continued over last 5 years, then you can take that margin, you can calculate your cash flows, and after that you can say do a discounting and come to a present value and see what it translates to. And then of course, then this will be paid over a period of time. It will not be paid upfront, because if you have a high margin, say 4 times, margin, sorry, 4 times, if you have a high multiple, so 4 times, in that case, that value will have to be paid over a period of time, because the continuity of revenue is very, very important for the multiple that you are given. So if that revenue doesn't continue, then you will have to make adjustment for the future payments which have to be made to the selling, which has to be made to the selling proprietary concern. Receipts are maximum with 1.5 years. That's for goodwill. Sorry, I didn't understand that question.
The question reading, ma'am, the 60-year-old proprietor concern, the same person has asked this question that receipts are maximum within 1.5 years and concern was run by father and then his son after his death. So same question actually by the same person.
Acha, acha, acha.
Hmm.
So receipts are maximum in 1.5 years means what?
Receipts are max within 1.5 years. The first question was 70% of gross billing, and then it was asked that the concern was run by father and then his son after his death. Matlab, father's concern was taken up by son, and the receipts are maximum, receipts received are maximum within 1.5 years.
So the billing. Okay.
Billing receipts, yes, whatever he has received.
Acha, receipt of billing is within
Hmm.
1.5 years. Okay. So then again, one just has to do a cash flow and come to a value of this business. It is very easy as such because you already have the margin. You know that this will be a continuing margin, but the buyer has to see whether this margin can continue or he has to build something more into this. So that is again a bargaining thing between the buyer and the seller, and receipts are within 1.5 years means that is the working capital which is built, uh, and that will also because in the first year when you are booking the profit, you have that as working capital because amount is not received, the cash flow comes in the next year. So that will actually give you, you know, what you can just build a cash flow that the working capital is liquidated in a year's time. You do your mid-year discounting, so 1.5 can be easily taken care of, and you can do a present value. You can build an Excel model very easily. You can build an Excel model based on this. That's it. Monthly billing and all receipts are within 1.5 years. Okay. So which means that okay, so there's a working capital which is built and it is liquidated within 1.5 years itself. So that's nice. So why don't you, you know, if you really want some help, maybe you can just connect with me. I'll just help you with the model so that you can work out, you know, what will be the value that you should look at.
Any further questions, please?
Yeah, I'll just send you. Yeah.
Yes, ma'am.
Okay, great.
So I think you have answered all the questions, ma'am, and there are no further questions. We
Yeah.
can we end it over here?
Yeah, I'm good.
I think, yeah, the participants are not asking questions. So, yes, thank you for the session. Wonderful session. Liked it. Many comments on. Very nice.
It's my pleasure. And this is the time for people to come together, because that's the way we can serve better. And that's the way to really grow and survive and grow.
Correct, ma'am.
So now I request Megha to take forward and give a well-deserved vote of thanks to Drushti ma'am.
Yeah, definitely. Thank you so much, Drushti ma'am. This was actually a very good session where we CAs got to know the ICI valuation standards 2018 in a very crisp manner. And this will help us to think from now that apart from our practice, just think about the valuation of firm, because we are always busy in calculating the value of others, individuals and the clients, and what about our firm. So this session was actually very clear, probably, and this will help us to all the CA practicing firms to ensure that what is next after retirement, or if they want to sell the practice, and how and what all standards they have to take in, if in case attendees have any problems, so they know that they can contact Drushti ma'am for all these queries. And secondly, I would like to thank WIRC for great wow series what they're having, because of which we are getting lots of knowledge and inputs on regular basis. That was really an amazing initiative by WIRC. Thank you so much to WIRC. And finally, I would like to thank the main attendees who, even after the network issue, I could notice that there were a lot of attendees till the end. Means they are so much interested till the end. So that thank you so much. Thank you for being connected with us, and your presence was actually important. Thank you so much. Thank you, Pinky ma'am.
Thank you very much
Thank
for
you.
this opportunity. It was really a pleasure.
Thank you, Drushti ma'am. It was very very enlightening, and we learned many things about our valuation. So thank you for your guidance and support always.
My pleasure.
Yeah.
Thank you. Bye.
Bye.